Dear investor, Nuvama Private is pleased to present you the latest issue of Investment Strategy Report for April 2023. Let's take a look at key highlights of March 2023. In the first half of financial year 24, borrowing stays front-loaded with gross issuances at Rs 8.88 trillion, which is 57.6% of total financial year 24 gross borrowing of Rs 15.2 trillion. India's external balance registered notable improvement in Q3 financial year 23. The country posted a balance of payments surplus, which has been aided by the moderation in the current account deficit alongside the significant gains in the capital account, viz. Banking capital. India's debt service ratio has eased over the years as core debt continued to contract. Compared to peers and its own history, India's debt service ratio is now lower, leading to reduction in financial stress. On the Indian macro side, demand-side indicators remain anchored. March 2023 witnessed the second highest monthly GST collection, indicating an uptick. Consumer Sentiment Index was also at record high. Quite a few supply-side indicators were showing mixed signs of recovery. On one hand, manufacturing PMI rose to 3-month high, and new investment projects announced saw around 80% quarter-on-quarter hike. While on the other hand, urban and rural unemployment witnessed rise in March 2023. Shockwaves were felt in US as they witnessed fall in the regional banks. Fed emergency lending to US banks was at an all-time high, and the shorter end yields dropped sharply post-bank crisis. Inflation stays elevated for developing and developed economies. Persistent high levels of inflation have prompted the central banks across the globe to keep interest rates elevated. The overall Indian equity markets witnessed some correction amidst the market volatility. However, small caps corrected the most in financial year 23. Sluggish activities in the Indian markets also led to market cap to GDP ratio hover around long-term average. At the current market valuations, the quantitative model is signaling at underweight allocation to equities, primarily due to yield gap being skewed towards debt allocation. The momentum indicators are suggesting sideways movement, though possibility of correction may not be ruled out. Global growth recovery is expected to be sluggish. The central banks in developed economies continue with elevated interest rates in order to curb the lingering inflationary pressures. In India, balance of payment improved significantly due to drop in CAD. However, receding credit growth from banking channels indicates slowdown in investments going forward. We continue with underweight stance on equities. In current scenario, it'll be prudent to be underweight on mid and small cap allocation as well. In the MPC meet held on 6th April 2023, repo rates remain unchanged at 6.5% and the MPC also retained its stance of focusing on withdrawal of accommodation. CPI inflation forecast lowered to 5.2% from 5.3% previously for financial year 24. And GDP growth forecast for financial year 24 raised to 6.5% from 6.4% previously. WPI reduced to 25-month low and CPI also sees mild reduction compared to previous month yet stays above the RBI corridor. Shorter duration rates have repriced significantly due to global market dynamic. We had already highlighted the opportunity of allocation to duration strategy in a calibrated manner. Post the amendments in Finance Bill, both mutual funds and direct bonds or NCDs as instruments can be considered. Our house view is to opportunistically add duration to the fixed income portfolio as we might be at the fag end of the rate cycle. RBI MPC decided to keep the policy rates and stance unchanged. However, the pause in rate hike cycle should not be construed as pivot considering CPI hovering above 6%. Given the stage of rate cycle we are in and given the flatness of the yield curve, we believe the allocation to duration strategy can be further augmented to maximum permissible limits in the portfolio for respective risk profiles. Post the amendments in Finance Bill, both mutual funds and direct bonds or NCD as instruments can be considered. Core allocation to high-quality yield-oriented papers is preferred. Investors can consider to lock in the yields as per their requirements with hold-to-maturity perspective.